Well, good morning. How's everybody doing? Hello, Brenda. Yeah, good afternoon. I guess depending on where you're at, huh? Welcome out to Trading Coach's Playbook. Trying to figure out why some of these things are moving big and other ones are just dying. It's interesting morning so far. We'll see how the day plays out, I guess, huh? Just trying to turn my phone off real quick, so that doesn't bother me. But somebody else decided to show up and it's going to bother me. I'm going to have to throw her out. You can ask any question you want, Norman. Whether or not I answer is the real question. No, she's going to lay down on the keyboard and start punching the things, and that's going to annoy you more than I do. All right, Renta. Hey, Kevin. What's up, Helen? It's still morning time, so I'm having coffee. Let me get through the disclaimer, though, Norman. Let me come back to your question in just a second. So, I'm not a registered broker dealer investment advisor. I'm not going to give any recommendations or advice. Everything we do here is purely for educational purposes. If you happen to mention a trade, just assume it is a paper trade or practice trade. For regulatory reasons, we do not discuss funded trading here. So let's see. Oh, no, that's a good question, Norm. Um, and honestly, there's absolutely nothing wrong with that. I've talked about that before. It's been a while since I brought that up, but um, so Norma's question is, if he owns a share of stock, say at 27, why not sell a covered call for a much lower strike and get a lot more premium? You just have to run the numbers on it. And the question is, what are you attempting to do? That's the real question is, what is it that your goal is? Do you think the stock is going to go I mean, if it's at 27, let's say that's a resistance level. If you think it's going to drop down to, say 24, 23, let's say you think it's going to drop below 25, you could realistically sell the 25s. You've got $2 of intrinsic value, probably, let's just say 50 cents of time, which is probably dependent on the stock, obviously, and the volatility of it. But if you collect that 250 and then it drops off to say 24, and that option goes down to say a buck, you could then buy it back for a buck. They put 250 in your pocket to start. You take a buck out and give it back to them. How much is left in your pocket still? You got a buck and a half, right? So you just banked a buck and a half because usually on a $27 stock, you're looking at, if you go out of the money, even say the 28's, just one strike, you're probably going to get maybe a quarter. So you're only collecting 25 cents on that. And then the question is, do you want to sit around and wait for it to expire, which is kind of the standard traditional covered call, right? You sell it out of the money call and either wait for it to expire, or if it goes above your strike and you're content letting it go, then you just sell it for that price. But I've made the argument that you could theoretically, and realistically you can, is trade it short term, just like you would do a swing trade. I mean, most of my trading is swing trading, right? So I'm buying calls or puts, buying at a certain price and then getting out, in a short time frame. You could take that exact same concept, the swing trading concept of being in for 1 to 5 days, and apply that to a covered call and sell when the stock rallies up and you think it's at a resistance, or if you think it's going to pull back, then sell a slightly in the money call, or even you could go deep in the money. Uh, Here's the caveat to that before I go forget about it. The deeper you go in the money, the higher the risk is that it gets called away before expiration, right? Because American style options, they can call it away anytime they want. As long as there's time value, this is just a general rule of thumb. As long as there's time value in the option, the odds of them calling it away early are slim. So you could, I mean, if you got, say this again, using your example, the stock's at 27, you could sell the 15s, right? There's probably there is $12 of intrinsic value. But if there's not any time value in it, then they could exercise it early. If you sell the 20s, there's probably going to be a little bit of time value in it. And they most likely, okay, it would be foolish of them to exercise it early. You would actually make extra money if you did. But if you take going back to the swing trading concept and you take stocks that you own and swing trade them on a short-term basis by selling a slightly or even a deep in the money call as long as there's time value in it. And then if it falls like you're thinking it will, then um, you buy it back at a lower price. So again, it's a little tweak. It's something you can do if it strikes your fancy. Is that the saying? Actually, Lan, let me do that. I will pull up a chart actually. Um, Actually, let's look at Intel. I don't know. It's fresh in my mind. I was looking at it earlier. So I guess it'd be easier to see visually. In fact, let's see. Nope. Okay. See, I told you, Brenda, she'd be obnoxious. She won't get out of my face and leave me alone. And as you know, I'm already the ADD party. Already, I have to focus on that. I can't worry about this stupid cat being obnoxious. Now, see, there's the good one right there. I know you can't see her. Actually, that's right. I have that background thing now. The real cat is back behind me on the router, just chilling out and relaxing, the way a cat should do, especially when I'm working. Um, but anyway, let me see. Guess we'll use the chart and see if I can pull up an option chain. We'll try to get realistic here. The only thing about her that is good is that she is persistent, but at the same time, that's obnoxious. Thanks for mentioning that, Len. So let's look at the November, see if I can just detach this puppy. Whoops. If that's working or not. Oh, yeah, she's a persistent little, you know what? Detach. Oh, there we go. Okay. Hmm. Okay, so let's do the chart on Intel first. Go down there in your little thingamajigger. Well, I was gone all last week, so the last few days I've been trying to get back into things this week, and they've been extra needy because I was gone for 6 days, I think, seven, or whatever it was. Yeah, I think I was gone for 6 days. So here's Intel, right? Intel's popped obviously on not only the news that the government has taken a stake in it, but Nvidia also, I think it was last week, put what is it, $5 billion into them? About a $5 billion stake on, or something like that, whatever the number is, the big number. So let's say you own Intel to 37, and you look at it and go, that's probably a little overdone run. I think it's probably going to pull back, kind of like it did back here, right? If you were suspicious that at 36 it was probably going to pull back a little bit, and you would have sold, okay, let's say at 36, you say, okay, if it breaks back below 36, I'm going to sell the 35s. Well, it came down to 33, which means that thing dropped about $3. And if we pull the option chain over here, try to put that somewhere I can get to it easy. The November, okay, it's at 37.19. That's pretty close. Yeah, it is actually 37.19. So the at the money's for 3. This is November, right? The November 37 is just a few pennies in the money. I'm going for 370. Got a delta of 56. You could realistically, I mean, sell those, but let's say you want to make even more. You want a delta of, say, 70 or even 75. So the 33 calls are going for selling for 575 with a delta of 75. So if it drops $3, the delta of 75, you're going to capture about $2. So if you think Intel is tired here and you think it's going to drop about $3, you could sell that for 575. If it drops about $3, then you're going to collect about $2 of premium. So you buy it back for about 375. You made $2 worth of premium versus if you say you go out of the money, and again, this is November, so it's 49 days out, but I guess there's the question is, okay, 33 that's three. Yeah, there's plenty of time value in that. If you do a traditional covered call and go out of the money, right? Let's say you sell the 40s, and a lot of it obviously is going to depend on your cost basis, right? How much did you pay for it? Where are you at? Are you up? Are you down? Some people, especially when the market, in the couple of market crashes that I've seen in the last 25 years, a lot of people own stock and they were underwater. So they use covered calls trying to reduce their cost basis down to where the stock was actually at. But Obviously, that's not the goal. So you got to factor that in. It's really just a matter of running the math. But let's say you sell the 40s at 250, and then you wait for November expiration. So even if it goes up, you're making $5, right? You're making 2.5 bucks of appreciation and 2.5 bucks on the covered call, which is nice. I mean, hey, $5 profit on a $30 stock is what, 14, 18%, somewhere in there. But let's say you want to do this. Let's say you get good at picking the swings and the spots where they're going to turn and move a little bit. If you can do that 3 times in a month, selling these for, five, say if you can capture $2 of the move. In other words, it moves $3 and you sell a delta of 75 and you capture $2 of that. You do that 2 times in a month, you're making $4 versus, doing the 40s at 250. Or let's say you sell the 40s and it drops $3, you're only going to get about a buck, buck and a quarter out of it, which is fine. I mean, it's a profit, but you know what I mean? So hopefully that answers your question. It's a really long-winded answer to a relatively easy question, but again, you just take the swing trading concept and trying to capture these moves when the stock gets exhausted, it gets tired, it's at a potential high, and you think it's going to pull back. You could sell it in the money and then buy it back, 1 day, 2 days, 3 days later. You could even day trade it if you wanted to. I mean, if you're worried the thing's going to move. If you get a stock that's volatile enough, I mean, Intel, I mean, lately it's been more volatile. I mean, you look at these days back here, you don't want to be day trading there, but these kinds of moves right here, especially if you're doing covered calls, you pick a day that's gapped up like this. If you can sell it there at 31.80 and it dropped about a buck, buck and a half by the end of the day, you can pluck 50 cents a buck out of it on a good day. So again, there's a million different ways to do this, and that's the beauty of this business is there's not a right or wrong answer. It's just a matter of taking what as far as how the strategy operates and either creating a hybrid, like taking a swing trade and a covered call and mixing the two. However, you got to slice it. But as long as the numbers work and the risk works for you, then go for it. Just so long as you understand, what the potential risks are and you don't get yourself in trouble. Which with a covered call, that's hard to do because if you already own the stock, I mean, worst case is that they're going to take the stock away from you, which, could create a tax situation for you depending on, where you're at with that. So a lot of little factors to consider, but again, just run the numbers and, figure out what's your trading style. And if it works for you, then do it. So there's all the upcoming events that we have. And you can find us on all the social media platforms there. In fact, that's a kind of a good little segue into what we're going to talk about today. If we haven't met, these are the tools that I have created, Patterns in a Flash, which is all about charting. So if you want, you can obviously go to the Wealth Builders HQ website and get that. Weekly Whispers, which is just my own research that I do for the week, and then I just record all my trading candidates. I usually have about 20 to 30 candidates every week. I go through a list of 300 to 400 stocks every week, just looking for patterns, hunting for a pattern, and then that narrows it down. I think this week I had 50, and I'll narrow that down to about between 20 and 30 usually. And just looking for the best of the best patterns. I don't have a basket of stocks, which a lot of people do that, but I have a basket of patterns I like to use. So, because they're repeatable and consistent, and that is the beauty of them. So, that's like I said, it's my weekly research. And then every Tuesday I do just a short recap on what has happened the week, any adjustments we may have made, or how things have played out. So, and then Small Accounts Big Return is a class I did a couple years ago. If you're working with a small account, it's a little more challenging. These days, it's not. Back in the day when I started in 2000, it was much more challenging because the cheapest commission I could find was 75 bucks a trade. So you start with $1,000 account, you're not buying that little $2.50 option. You buy two of them, it's 500 bucks, but then your commission is 75. You got a commission of 75 going out too. So you need a buck and a half move just to get to break even. So it was significantly more challenging trading back then than it is now with commissions the way they are. They are dirt cheap, relatively speaking. So they're basically inconsequential. I don't even look at it. I don't even know what I pay. I know it's pennies though, relatively. So, but really going to talk about mainly two things here. Number one is how do you utilize the 3-to-1 risk reward ratio in scaling, mostly from a mindset perspective. because that is these are the two things that I have implemented over the years that completely changed the way that I trade. And when I say the way that I trade, what I really mean is these two things got me to a place where I trade in a calm, cool, collected manner, which should be the ultimate goal, is get to where you have your emotions under control. That is the hardest part of trading. And if you don't have your emotions under control, and if your emotions are beating you on a regular basis, then in the end you're going to be losing. So the goal, I don't put number goals. I've tried that, never worked for me for whatever reason. My only goal when it comes to trading is making good decisions. That's my number one focus. And if I do that, then the numbers follow. Everything will work out. And the two things that I have implemented over the years that dramatically changed are the 3-to-1 risk reward ratio and scaling. And I would venture to bet, considering that we're all pretty much the same and we all have the same emotions, and uh, how we respond to those emotions are the thing that differentiate them. But if you could take the two main pieces that I've used to get to a calm, cool, collected state, then it should work for you as well. So, um, the one thing that's hard to get away from is the right wrong mindset. Right? As I mean, it's so easy to get stuck in that mode, and we're naturally there. I mean, how many of you went out and intentionally said, "Well, I'm going to do this because I know it's wrong." Right? We don't ever do anything intentionally wrong. You don't go out and make a mistake because I just want to see what it feels like to make a mistake. It's just not there, right? So our predisposition is to be right. And because we want to believe that we're smart and intelligent and we're good people, then we think we're going to be right. But trading is not about being right or wrong. It's about making more when you are right and losing less when you are wrong. Letting your winners run, cut your losers short. You've probably heard that one, right? That is the goal. But the key is to not focus on being right. And that is so easy to get in that trap. And I fell into it. I was there. I remember probably 6 months in, going through charts, studying charts, and doing all my charting stuff. And I'm like, man, if I can get good enough at reading charts to be right 70 or 80% of the time, I'm gonna make a fortune. Boy, how wrong was I? It was crazy. First of all, getting into that, and a lot of it depends on your strategy, right? If you're doing non-directional stuff, covered calls, spreads, those have a different risk reward profile. Mainly what I'm talking about here is my trading style, which is swing trading, right? Either long stock, long or short stock, or buying calls or puts. So you got to keep in mind that part right there, because you get into spreads, you get into shorter term, certain types of trading, like scalping, very short term, some intraday trading, depending on what you're doing. You can get a really high risk reward profile, or you can get a really high win ratio. If you're just going in and taking out a little tiny snippet here, a little snippet there, your win loss ratio can be really, really high. The challenge to that, especially when you get into this scalping type of trading, is if one goes against you, you take a nickel here, a dime there, a nickel, a nickel, and you lose 50 cents, you're still upside down. So it can be done. I know people that do it. It is challenging. It's not my style. I've tried it. But the key is to, if you're scalping or doing a really short term thing, you've got to get a really high win loss ratio. But if you're doing more swing trading, and that's one of the reasons I like it, it's not as wild and crazy. Even though I like wild and crazy, that's the weird thing. I love risk, but at the same time, I don't like to lose. I mean, who does, right? So I've kind of created this hybrid where I'm taking the risk, but it's not as big as it would have been, so that if I lose, it's not as bad. We'll get into that in the scaling part. But the 3-to-1 risk reward and the scaling, I've already touched on that. Fear and greed, which actually I consider greed actually to be just fear. It's FOMO, right? You've all heard of FOMO, fear of missing out. Greed is just that, oh, everybody's in, and I think that's where we're at with this market. I mean, looking at it right now, hitting highs again on I think everything. All four major markets are hitting highs, are they not? That's in my way. I can't see the Russell. Yeah, 24.97, 47.041. Yeah, we've hit fresh highs on all four markets, which in a way, actually, I mean, the Russell's been the one holding me back from turning bullish, and now I'm like, I might have to join the bulls. Uh, so, but at the same time, how long will this thing keep going? And it could go forever. I mean, what was it? Buffett got out of the market, what, 94, 97, I think it was, 3 years before the dot-com era died. I think it was '04 when he started to get out of the market before the real estate crash. But he is in 27% cash right now. This is the last I heard. So, and his historical average is 13%. So, Buffett is looking at this market and saying, if something doesn't add up, the numbers don't add up. Even though I don't follow him, hardcore because I'm not a fundamental guy, but he is very good at recognizing when markets are overvalued and they're probably not going to stay up too much longer. And if you were around during the dot-com era, you know how many people were out there on TV and all these other pundits and other people were talking about what an idiot he was. Buffett's a moron. He's missing out on the greatest run in history. And he even said, people asked him about it. He said, that might be true, but it's all right. I'm sticking to my strategy. He knows his style. He knows what he does well, and it's worked for him. And he stuck to it. And then in 2000, when everything started to tank and all these dot-com companies that had nothing all started crashing, all of a sudden he was a genius again because his valuation went up because people moved out of dot-com and into old school stuff like railroads and Coca-Cola and foods and all the stuff that he owned is where people went to when they started fleeing from tech. So it's funny how things shift, and sometimes it takes a while for the truth to be exposed. But as I think it was him that said, right, when the tide goes out, you find out who's naked. I think that's Buffett's quote, isn't it? But he doesn't worry about missing out. He's not like we are, right? Well, he is. He's like us, but he's become very, very disciplined and sticks to his strategy. So, and that right there. That concept itself is good advice. Do figure out what works best for you and focus on that. Buffett has his style and he sticks to it. He doesn't deviate. So figure yours out when it comes to trading and stick to it. So I love these ideas. I had this I replied to some thing on Facebook the other day. And this guy comes back and and it's like, you don't think buying the spider ETF is a winning strategy? I'm like, maybe in the short term, but I think long term this market is getting a little overheated. I mean, we're in bubble territory. Real estate's bubble. The market's in a bubble area, which bubbles can keep going for a long time, right? Just like the balloons, right? At the fair, we just had the fair here. I didn't go this year, but the little water thing, you shoot the thing in, and the balloon starts blowing up, and then it explodes, and whoever explodes first wins. They go for a long time, and they stretch a long time before they explode. And this is no different. We could have another 2 to 3 or 4 years of major, bullish rally if this thing keeps going. But the one thing, and I haven't confirmed this, but because I watch a lot of different people on YouTube and other places, um, and the one guy said that if you take out the Mag 7 from the S&P 500, it is still in bearish territory. I haven't pulled up the data to actually confirm that that's true or not, but the Mag 7 is what is driving this market because the big boys are dumping tons of money into AI, and they have the money, they have the cash, and they're resilient. It's the little guys that are not quite as good. But again, now seeing the Russell breaking out, which a lot of that's banks too. The small little regional banks are in the Russell. I think that's the biggest part of the Russell is the small regional banks. But obviously, something is getting better. Either that or people are just really super greedy. I saw another thing too that was really interesting where there are this guy did a video and there's a whole bunch of data points in there. I know I saved it. I wanted to go back and get them all, but the one that I really remembered was insider trading. And typically you've got about a 3-to-1 ratio on insider trading. So there's 3 times as many sells as there are purchases. Because insiders, they already own a huge chunk of the business. If they started it, they might own 30, 40, 50, 70, 80% of the stock. So they will sell on a regular basis just to diversify, right? If you got all your wealth in one stock, then it makes sense to unload some of it. And they need new homes and new jets and all that stuff. So you gotta sell a few $1,000,000 of your stock. Or in Bezos' case, he needs a $500 million yacht. And I say, hey, more power to him. You started it, you get the fruits of your labor. But uh, so that ratio is usually 3 times as many cells. And I think it was July that they had the data for. And the purchases versus sales was 0 purchases to 200 sales. So insiders were selling, they were buying nothing, 0 purchases from insiders, which I thought was a little, seems like somebody would be out there of some company. Maybe it was just of a slice of the market. Maybe it was just the big companies. I don't know exactly what it was, but 200 sells, which Michael Dell sold recently, I heard. Which that's what happens when the market gets hot and overheated, or maybe it's not overheated, maybe it keeps going, but they know their stocks well. They know what the future holds. So when you get massive amounts of sellers from the insiders, that's usually a clue. So even though we're breaking out to new highs, things could change very, very quickly. So, and they could keep running. That's another, actually, that's a good argument to be made for trading short term because we don't know what's going to happen long term. The government shutdown is now, not doing much. I just noticed I got CNBC running over there in the corner, private credit cracks forming. There's lots of different things, and this is another thing too, is that if you pay attention to a lot of the stuff under the surface, the private equity market, private placements, if you will. So they're not public stocks, they're not public companies, but they're going after people with money that will invest privately, right? I don't know how to put it easily, but um, they are getting to a point where they are trying to sell their private placements to the general public. I saw something a couple weeks ago. They're trying to change one of the rules. There's certain rules around investing in private equity and private companies. You have to have a certain net worth. I don't remember what all of them are. But now, because their sources of buyers are drying up, the private market, the people with money that they would normally sell their private placements to, have either pulled back or they're just not investing in private anymore. So they're trying to figure out how to sell these private placements to the general public. That is a sign when people are getting desperate enough to sell it to your average Joe because they don't have any customers elsewhere. That's a sign that there's cracks. There's something not right. Something's off. So, well, the new highs keep getting touted, and we're going new highs, new highs, new highs. And that's fine, especially if you're long, if you own stuff. But eventually those cracks that are under the surface will start to show up. So you've got to pay attention to more than just what is you see on the surface in the mainstream media, and hence the reason I go to a lot of these other sources of media that are, that's one of the beauties of, even though I can't stand Google, but YouTube is good because there's a lot of other information that you can't find in mainstream media. You got little mom and pop Joe Schmo that isn't known enough to be on CNBC or a major network, but they have good data, they have good information, so they can put it out there, and if a bunch of people go see it, then they get compensated for it. So it's a good thing to have that. It levels the playing field, if you will, and it allows us to access more information that we couldn't get anywhere else. So, are they changing the day trading rule when it comes to margin? That is a good question. I have no idea. Oh, really, Trip? Thanks. I haven't heard of that one. Ground.news. I assume that's the URL. Ground.news. That's a new ending. Okay. Tripp said go to ground.news. It's a news aggregator. That's cool. I'm gonna check that out. That's another reason I love doing this. Get ideas from other people. Like, hey, check this out. It's like cool. So, but getting back to the PowerPoint, um, that's the one thing we know, right? We all know that market's driven by emotion, and a lot of times our own emotions can be our biggest enemy. Anybody ever had that thought? You know, if I just did the opposite of what I was thinking or feeling, I'd have $5 million right now, right? I'd be a multimillionaire. If I just did the opposite, um, yeah, that's right, Brendan. Ground.news, not .com, but .news. Um, for news, yeah, it's a news aggregator. Tripp said. I haven't seen it. I don't know anything about it. It's the first I've heard of it. So I'm just passing it on because I know Tripp knows his stuff. So, and actually, Norm, if you want good covered call information, go to Tripp's class because he does the cover. He's the covered call king. Brandon said, "Thanks, Tripp." The fear thing causes to cut winning trades short and a lot of times miss the profit target, which we've all had that happen, right? You get in, you get up a little bit, you're like, I'm gonna get out, take my money and run, and then it keeps going. And you're like, so, and then greed, in other words, FOMO, you hold on to losing trades, right? Let it go past your stop, or you hold on to a winning trade too long. But that's one thing we're going to talk about. We're going to talk about scaling and how that helps manage that emotion, right? The FOMO, the greed emotion, scaling helps that big time. And then the plan is a predefined risk reward ratio. It's your less emotional rule book. That was actually originally non-emotional. There's no such thing as non-emotional. Anytime somebody says learn to trade without emotion, I say run. You are never ever going to get to a place where you trade without emotion. Not going to happen. I'm a little bit emotional today because I had a trade that was winning and it backed up against me fast enough and far enough that I not only let all my profits go away, but I took a small loss and I'm like, but it happens, you know. So it wasn't a bad trade, but I could have made some adjustments to it that would have been better. So I got in and things were good. It moved really fast in my favor and then it bounced back really quick. So the volatility is what I wasn't expecting, but it happens. So 3-to-1 risk reward ratio. Okay, there's the other one. Now you're in my way. I need my coffee. Crazy cats. Again, let me put this caveat out there that this applies to directional trading, right? If you're doing uh, spreads, covered calls, if you're doing non-directional type of trading, this doesn't really apply. Um, which I thought about this a few years ago, and then I was like, I never done it, and then it hit me again recently, doing debit spreads. Debit spreads actually have a good 3-to-1, and I did one on MSTR as Bitcoin had been falling. Ended up doing a long term out to December, I think 275, 280 bear put spread, a debit spread for $1.25. I was just testing it, so I just did 3 contracts. So I'm going to try this out and see if it works out. And I threw out an order for 2 contracts at 250, or maybe it was no, I think it was $2. It was $2, 205. So I'm like, okay, I got $375 in this trade. If I can close out 2 of them for 205, that's $410. So I got 375 into it. I get 410 back. That covers my commission and leaves me 20 or 25 bucks of profit. And then I leave the other one there. And if it keeps dropping, then I'm just making more. If it actually goes below the spread, then I'm collecting the whole $5. But I had no risk on it. I got all my initial capital back. And now I leave that one contract there to see what happens. And if it ends up expiring worthless, okay, I still made 20 or 30 bucks. If it doesn't, it keeps going, then I have the potential for max profit of $500 with zero risk. That's the scaling thing. That's what we're kind of getting to. But when you use a 3-to-1 risk reward, this is the beauty of it, why the math works. You can be wrong 7 out of 10 times. Now, usually this is where I ask people, how many of you want to have a 95% success ratio? And everybody raised their hand and says, yeah. Okay, well, 95 out of 100 trades you make $1 on. The other 5 trades you lose $100 each. And people start thinking that, oh, wait a minute. That's $400, $500 loss and $95 a gain. I'm losing $405. Your win-loss ratio doesn't mean squat when you're talking about directional type of trading. It's how big are your wins versus your losses. If you're making $300 per trade, as you can see in the example, if you get 3 winners at $300 a piece, that's $900. You have 7 losers at $100 a piece, that's $700. You're still up $200 net profit. Yet you're only 30%. 30% of your trades went in your favor. You lost on 7. There's another reason that old saying, this is let your winners run and cut your losers short, works. Because of that right there. Because it doesn't take too many big wins to make up for a lot of little losses. That right there, the one thing that this did for me when I first realized it, because I learned risk reward early on, like 3 to 6 months in my trading journey, if not sooner. It's probably one of the first things I learned. But I didn't utilize it in this sense. And the biggest thing was the mindset, because what I eventually did is like, okay, why am I not using this? Because I don't remember if I saw something somewhere or it hit me. I'm like, you know what? Why am I not using 3 to 1? For this reason right here. Because I don't have to be right that often. I was like, okay, I'm going to implement this on my next few trades. And so I created a plan. And okay, here's if it hits this, then, there's my target, there's my stop at 3 times as much upside. And the next 3 or 4 trades, I think it was 4 if I remember, this was 15, 18 years ago, but the next 4 trades I did had that plan in place. And I had a few other trades that I'd been sitting on here for a little bit. And I realized that these 4 over here that I had just put a risk reward on, I didn't really care what happened. I'm like, just go. I don't care what you do, move. Because if one of them moves in my favor and the other 3 go against me, I'm going to be all right. I'll be about break even, maybe a little bit profitable, depending on the size of the stock and how much upside you have. I mean, if you have one that you have $20 of upside, and the other ones you have $2 of downside, then obviously that's going to skew the numbers. But in the long run, which is what we should be looking at, is what's the long-term picture look like? If you implement a 3 to 1, then in the end you're going to come out ahead as long as you're 30% accurate. But all of a sudden I realized these ones that I had over here that I had created a plan, I had a 3 to 1 risk reward. I wasn't concerned about them. I was calm, cool, and collected. I was like, I'm not worried about these trades. These ones over here, I used to think I was a solid trader, and I was decent. It's always funny how you get to that next level and you look back and you go, oh, I was terrible. I thought I was good, but I wasn't. uh, I was nervous and anxious about these ones. These ones over here, I'm like, I don't care what you do, just go. Go somewhere. Move. Either up or down. Stop me out or move in my direction and hit my target. That's when it dawned on me, when I had that massive contrast, how powerful this is. Not just from a math perspective, but from a mental and emotional perspective. You implement just this one thing, and I don't think he's here, is he? No, Will. Every time I show this, Will's just like, oh my gosh, that completely changed it for me. He's the only one that I could think of that on a regular basis tells me that this changed his trading. Just from a mindset perspective. Forget the math part. I mean, don't forget it, but it's one of those things when you recognize the math and you realize that you don't have to be right very often. That was the big thing for me because I was so focused on being right all the time. I want to be right 70, 80, 90% of the time. I don't need to be. So why am I trying to be? Why am I trying to do something that is virtually impossible? It really is. If you're trading directionally, right? Just like baseball. That's what this goofball on Facebook was saying something about. Oh, you should just something about dollar cost average. You think you're smart enough to time the market? Yeah, I do actually. How do I know? Because I've done it. It's like results don't lie. And then that's why I use the baseball analogy. It's like just because you can't hit a 90-mile-an-hour fastball doesn't mean that others can't. Some people in this world have developed a skill to get out on a baseball field with 40, 50, 60,000 fans screaming and yelling, step into a batter's box and hit a home run or hit a single. Just get a hit, period. Some people have developed that skill. There's not many that get to that level. But just because you can't doesn't mean it's not possible. So, but that's the thing. I mean, a baseball player, what? The best of the best are hitting what, 250, 280? What's Judge's batting average? Is it like 265 or something this year? And then our local boy here in Seattle, Cal Raleigh, like 250, 260, I think they're at. So they're getting hit 25, 26, 28% of the time. The other 75% of the time, they're not getting a hit. They're striking out, they're walking. Yet they're still making a fortune. Baseball players use 3-to-1 risk reward, basically, right? Not really the same, but conceptually, you know what I mean. Um, this is pretty basic, right? You analyze. Obviously, I'm looking for breakouts. Usually, that's my style. Looking for a pattern and then a breakout of that pattern. Set your stop loss. Set your profit target. The golden rule is good to follow. Not the one from the Bible, but the one from the trading Bible. If you can't find a good 3-to-1 risk reward ratio, don't take the trade. If the risk reward is not there, do not do it. Or adjust the risk reward so that it is there, or adjust your position size. There's lots of different ways you can adapt it. Because you might look at it and say, okay, I'm going to do, here's my risk reward. If the stock goes against me, it's going to cost me $3,000. I don't really want to give the market $3,000 to find out if I can make nine. I'm not comfortable with $3,000 of risk. Okay, well, how much are you comfortable with? 1,000. Okay, well then cut the position by 2/3. Instead of doing 10 contracts, do 3 or 4. So you can still, if the numbers are still there, but the risk reward is still there, but that number of your risk is higher than you're comfortable with, then adjust the position size down to where you are comfortable. The key really is to making sure that you're not taking so much risk that you're not in a cool, calm, collected space. As long as you can stay in that cool, calm, cool, collected mindset, then you'll make good decisions when you're trading, especially when the bullets are flying and the market's open and something's going on. Like right now, I've got a couple that are going against me. It's like, but I've got other ones that are working out in my favor. So it's not necessarily a wash, but in the end, it will work out fine. But if you can answer the question, am I comfortable with the amount of risk I'm taking in this trade? Then you can pull the trigger. If you can't, if you say, am I comfortable with $3,000 of risk? No, I'm not. Okay, then either don't do the trade or adjust it so you can answer that question, yes. Now getting to scaling. Entering or exiting a position in pieces instead of all at once. When I started, all my coaches were doing 10 contracts. It's 10 contracts in, 10 contracts out, which is fine. It works. If that's your style, if that's your strategy, that can work. But I know many of you have heard this story, but Baidu, I think it was 2005, company who hadn't been out that long, it busted north of 80. I'm like, this is a perfect breakout. It's a beautiful pattern. It pulled back in the morning, shortly after the open. It gapped above 80, pulled back, tapped 80. I'm like, that's a perfect setup. But I'm looking at it going, and I was still fairly new. I'd only been trading for 4 or 5 years at that point. Which now looking back, I was new, right? Back then, I didn't think I was new. You never do. But I looked at the amount of risk I was going to take if I did all 10 contracts like I had been taught and I was doing essentially. I was like, that's too much risk. I don't want to risk that much. It's a highly volatile stock. It's an expensive, well, relatively expensive option. Back then it was. Now it's average basically, but fear kept me out. I didn't get in at all. And 2 hours later I came and looked at it. It had run 4 or 5 points. I'm like, I missed it. 4 days later it was at $120. Went from 80 to 120 in 4 days. And I was beside myself. I think the options were $4 or $8. I don't remember exactly. But they were in the 20s 4 days later. I was like, why didn't I just buy one? If I didn't just bought one contract, I still would have made a 3 or 4 or 500% rate of return, whatever it was. Yeah, the number wouldn't have been huge. I wouldn't have made 20 or 30 grand, but I still would have made 2 or 3 grand on a 4 or 5 or $600 investment. And that's when it dawned on me. I wish I would have just bought one. And that's where my mindset started to shift. I'm going, I need to adjust this position sizing, not just always do 10 like I've been taught. So scaling in, which there's a couple of different perspectives you can take this from. You can add to a winning position, right? If it's something's moving in your favor, you add to it. which can be good, right? Or a combination is you nibble on trades. Let's say you find something and you're like, well, not really sure if it's going to move that much, or I'm not that confident in the other patterns. Maybe kind of, it's a decent pattern, but it's not that strong. Maybe the volume's not that spectacular. Maybe it's not at a major support or resistance level. Maybe the breakout's kind of weak. There's all kinds of reasons, right? You analyze it and you go, I'm not that confident in this. So instead of doing a full size position, whatever that might be for you, you just do a little bit. You pick up one or two contracts instead of 5 or 10. And then if it continues to move, the other way is you get into a trade early, right? You say, okay, I think this is going to break out. Maybe it's still in a pattern, but it looks like you've got other signs, other analysis you can do that you say, okay, I think it's going to break out. Let me take just a tiny little position in case it does, and then I'll be ahead of the game. Or then I can add to it if it breaks out. So there's lots of different ways. Again, there's no right or wrong way to do it. It's a matter of taking your analysis and based on your analysis, taking a position that makes sense based on what you believe is going to happen next and where your mindset is, where your risk reward is, and how much you're willing to risk. Scaling out simple, taking partial profits as a trade gets towards your target. I do this all the time. I get into something, I can get in and out. Sometimes pick up one or two or three contracts and then add to it and then take out two or three here. And then, it's just a constant jockeying and trying to keep the position size in a place where I'm comfortable. But then if I can bank some profits as it's moving in my direction, then I'm reducing my overall cost basis. And if it keeps going, great. If it backs up against me, okay, I don't give back quite as much. So again, it's all about managing the emotions. There's a scaling out thing, which I mean, well, this is the one thing I like. Just like I said with MSTR, right? Sell a third of the position, lock in the profit, move your stop loss to break even. This makes the trade now risk free. I don't like the term risk free because it's not necessarily the case. Just like Nike, right? Nike, I did a Grand Slam trade on, which if you haven't heard me talk about that, they came out with earnings on the 30th, just Tuesday, I think. But I'd gotten into Nike 2, 3, 4 weeks ago. I bought some puts. Again, usually I don't take huge positions on these, but I bought some puts on Nike, put an order out for 2/3 of it at the break even level. So I don't remember how much it was, but let's just say it was $2,000. And I put an order to sell 2/3 of it where I would be collecting $2,000, get all my initial capital back, and then left the other third of the position there and hold it through earnings. Because one thing we say, don't ever hold through earnings. But what if I can get into a trade and get all my initial capital back and leave a little bit there so that if earnings comes out and it moves in my direction big, this is massive gravy, right? It's like the old chicken trade, just a variation of the chicken trade, if you will. But at the same time, so Nike, the options that I had left over were trading at, I think, 3.5 or $4 at the close of the market before earnings came out. And then earnings came out and it jumped about $3 or $4 to the upside. So they dropped off to $1. And I'm like, ugh, that's annoying. Of course, if it would have done the opposite, if it would have dropped 3 or 4 points, I would have banked it. If it would have dropped 10 or 12, which is what I was hoping for, they'd have been worth 10 or 12 or $13. I think I paid $3 for them. $2, something like that. They were longer term out of the money options. And I'm like, okay. But I got all my initial capital back. So, and I waited for a little while. Then I ended up selling, I think, for 60 cents, which was technically profit anyway, because I didn't have any money in the trade for my initial starting point. But I had the potential to get, a massive home run. They don't come up very often, but when it's earnings season, if you see a pattern, you find a candidate that could possibly do that, think about it and see if it works out. It worked out well a couple years ago. I've only had it happen 4 or 5 times where it panned out. And one was on Home Depot. And same thing as with the Nike. This time it gapped in my favor. I think they were $12 or $14 the morning or the day before earnings. And it gapped down. They were worth 24 or 28 the next day. So I banked an extra $1,000. But I didn't leave. That's why I don't like the risk-free term, because there was, well, with like the Nike, I mean, I could have cashed it out the day before earnings and collected the 350 or $4 of premium that was there. Same thing with Home Depot. There was 1,000, 12, 1,400 bucks at risk. And I knew that some of that could go away. It could have all gone away, but I was willing to take that risk. That's really what it comes down to. Controlling emotions, right? AI, this is, AI can help us in a lot of ways, and I'm still playing with it in a lot of ways, trying to figure out how to utilize it in better ways that enhance our trading, if you will, but can help to manage your emotion, right? Algorithmic trading is predefined rules, which is kind of what I use. I'm just hitting the trades manually. Algorithmic, you're essentially programming, you're coding it in and saying, if this happens, go do this. And then it just goes and does it. You don't have to manage it. It does it by itself. It's all automated essentially. AI can help identify certain things. I don't use it for support and resistance levels, probably because, I've trained my eyes to see it all. So I see it without even, it doesn't even, it's like seeing 2 plus 4 on the screen, right? You don't even think about it. It's just six. So eventually you get to that level where it's like, okay, automated execution, that's possible with, well, it's algorithmic, but there's a lot of different ways to start to use AI to see things. But um, smart risk management, emotional management, I should say. I should have changed that from risk management to emotional management because that's what the main thing is. If you use three to one, it will totally change the way you trade from an emotional standpoint. When you get rid of this idea that you need to be right and it's like, oh, it's all about hitting a home run every single trade, and it's like, just implement a 3 to 1, calm, cool, collected, and use scaling. Use scaling to manage your emotions in a sense that you get into the right size trades without having too much risk and freaking out, because if you're not sleeping at night, you're doing it wrong. But then also peeling profits off as it moves, so that way you have more of a cushion in case it does back up against you. Because if you've been trading more than a couple of days, you've had that experience, right? Where you get up. I just had it today. It was up. A quick little day trade, was looking to pull a few $100 out, and it ends up moving quick in my favor, and then turned back against me and ended up costing me $300. The $500 or $600 reversal, actually. So it's kind of irritating when that happens, but it does happen. It's the nature of the beast. And I'm a little cranky today because of it, but it's like, and I of course I wanted to go back in and trade again, but I'm like, no, I had to. I know that my mindset is I'm upset because I should have banked a little bit of a profit, but it did move so fast that it was hard to. So it wasn't a bad trade, but I could have. I think I said this earlier. It wasn't a bad trade, but I could have adapted to it and turned it into at least a break even, or maybe a small profit, or even a smaller loss. But um, it is what it is. It wasn't a horrible mistake, but it's still frustrating. Even when you lose and things, even when you do everything right and you lose, it's still kind of frustrating. But I couldn't get into the revenge mode, and I felt myself go in that direction. Like, okay, now I'm mad, I'm upset, I want to go back and make my money back, at least get back to break even. That's where my mind went. That's the natural place to go to. I'm like, no, I'm just going to take my beating for the day. I had one the other day. It was aftermarket. It was a futures trade, right? And if it breaks out of this level, I think it's going to run. And so I just I threw the order out there, just an OCO, and left it out there, and it hit. And we went to dinner with my neighbors, and I happened to pull up my phone and look, and it was like, what just happened here? It had been like an hour, $665. I wasn't even paying attention. It had a trailing stop on it. Boom! It had run up really fast and then pulled back and hit my trailer, and 600, almost $700 in an hour's time, and I wasn't even paying attention. So uh, that's just the nature of the way it goes sometimes. So today is, even though it's frustrating, I got to remind myself that those ones right there will make up for things like today. So, and it's about the long-term picture, not about one individual trade. So that last one there, the call to action is good. Before any trade, ask yourself, does this have a clear path to a 3 to 1? Or are you comfortable with the risk you're taking? Or another one that I like to ask myself is there a compelling enough reason to get in here? There's lots of different questions you can ask yourself to get to a place where, okay, can I do this trade and not be freaking out about it? However, you got to come up with that question that gets you into that place where you are in a calm, cool, collected state. Let's put this into actual, well, let's look at a few. I don't know where that one went. But I'll show you. I mean, this is essentially what I do as far as risk reward. I'll show you on the charts what I do. And here is this is uh, Barrick Mining. Little cranky. I didn't get in back at 22, but I'm looking at this going, okay, looking at the long-term chart. There's a weekly. When it was down there at 22, it bolted up to 26 real quick, and I went, eh. Usually when it runs like that, I get a little skittish because it's not normal that it takes off and just keeps on going. But if you haven't noticed gold has been on a tear. It was 2000 at the basically at the beginning of the year, and it's at almost 4 right now. Actually, the December futures are 39.08. It's hit 39.20. So I mean, gold itself is around just shy of 3,900. And I'd say the odds are we're going to run up and at least tag 4,000, which should be another huge warning sign. Why are central banks all over the world and countries themselves buying up so much gold, like physical gold? They're not buying the futures, they're buying the actual metal itself. There's a massive influx of cash from foreign countries. The US, or something like 4 billion brought into um, JP Morgan, I think, bought $4 billion of physical gold. Um, Interesting thing I found out a couple of weeks ago is that I think it's the New York Fed where they have a huge gold stash. There's Fort Knox, supposedly, right? Supposedly there's a gold stash there. But then I think it's the New York Fed, whatever it is, there's a big building in New York that 5 stories below ground, there's a gold vault. And I think they said it's the second biggest stash of gold. The non-discrete building, you can't tell. Funny enough, right across the street is JP Morgan Chase. And guess what they have? Also 5 stories below ground. A massive gold vault. Huh. Coincidence? I don't know. It's a little conspiratorial, but it's like, oh, that looks fishy. So who knows? But either way, countries, central banks all over the world. I think Argentina just bought 50 billion or something like that worth of gold. They're buying the physical metal, not, like I said, they're not trading it. They're buying the actual metal itself, um, which should be a warning sign. Even, like I said, even though we're hitting all-time highs, gold doing what it's done is not normal. It's not normal. And if gold does what it's done the last 2 times it's had a massive run like this, it's headed to about 8 to 10,000. So if you go back and look at the long-term chart on gold, the metal itself, the COMEX, however you say it, it is the last 2 times it had I think it was 550 and a 600% run. So, and one was over about a 5 or 6 year period. The other one was, I think, 7 or 8 year period. So, um, we'll see. But just knowing that that the underlying metal is going crazy, these gold stocks. When I'm looking at that here, back here, even though it made this massive run, which usually would scare me away, but I'm looking at it going, number one, you can see the other thing, the volume is increasing, right? It's been pretty light. I mean, kind of steady back in here, but then when it broke out, it didn't increase a ton, but it increased quite a bit. I went with the metal, underlying metal coming out, these things are running as much as it has, being up 40 or 50% for the year. These gold stocks have a huge potential for massive profits because their costs aren't necessarily going up much at all. But the amount they're going to make, the amount they can sell the gold they dig out of the ground has almost doubled in a year. Their profits are going to be crazy. Hence the reason that they're rallying like mad. So I expected that they probably would. So my risk reward plan on this one was, when it was sitting right around here at 26, it had rallied up there. So the entry was 27.09. The target's up here about 40.41, which is I think it's the all-time high, wasn't it? Pretty sure it is. Oh no, it's not, but not the all-time high, but that's a weird split thing. I'm not sure what that's all about. But either way, it's pretty close and figured it was going to 40. If it goes to 40 from 26, you're pretty happy camper, right? And same thing with NE. I got into NE back in March and started trading it, buying longer term options, and have absolutely killed it with that. And this one too. But there's the risk reward potential. I'm about halfway, and I've peeled out. I peeled out a little bit here. I don't remember where I got some of the others out, but then I've added it back in, so you can get out. Again, I don't remember where I took profits on some of it. I know I put an order up above the market, so if it hits this, I think it was 50 or 70% profit. It took it out and then it pulled back and I reloaded it somewhere. I think I reloaded a little too early. And then it took off. It was like, holy cow. That was cool. And I've peeled out. I still have some. I'm still holding on a little bit of it just in case it takes off without me. But I think we're due for a slowdown in gold at least. But that's one. Let me grab another one or two here real quick, and then we got a boogie. Disney, here's one that nice looking descending triangle, right? And it broke down the other day. And this is one I just nibbled on. And this is the scaling in part that I love to do. So we've got, obviously there's a little bit of support right there, and it came down. I don't remember which day it was. It was one of these days, I think, where I'm like, okay, it's not to my entry point. And you can see I have a 3-to-1 and 4-to-1. This is the drawing tool I use on here. What's it called? The advanced risk reward. You just have to structure it for whatever you're doing. But I have the 3-to-1, but also a 4-to-1 line. 1-to-1, 2-to-1, 3-to-1, 4-to-1. So that allows me to visually see where we're at with regard to where my 3-to-1 target is. I'd love to get to 4-to-1. Don't know if it's going to happen. I'd love to see it drop all the way to 85. But we've got that support there about 113. And when it got below it and it started kind of dancing around here, I nibbled on a little bit. So scaling in. In other words, I'm like, okay, it's not that far below the support. And there's a little minor support here, which we haven't really broken. But if I get in somewhere up in here above my actual entry point and it goes against me, if I just get 2, 3, 4, 5 contracts, then it stops me out, then it doesn't cost me a whole lot. And then if it breaks down, then I can add to it if it gets down to here. I don't remember if I did that or not on this one, but I think I did that on another one. I think it was on match, but you can see there's the risk reward and it's visual. It's very easy to see. Now, like, okay, and that's why I have the 1-to-1 on there. So I can see, okay, I've got $4 of risk. I don't have to do the math on this anymore. Because this is a 1-to-1 risk reward. 401 is what I have a risk. Depending on which, if you're buying an option, then obviously you got to take the delta and calculate it out. But excuse me. So that's one of the things I love doing is nibble on it and then add to it if it keeps going. Yeah, you can create that on toss as well. I do have it. I don't remember what they call it on there exactly, but it is possible. I use it on both. I'll usually draw it on here first because this is where I do all my analysis. Toss is just a trading platform for me. I don't analyze things on there because the charting sucks as far as analyzing. But yeah, there's match. A nice double, triple top, basically. And it was one of these, I think it was the day after it broke down. And I was a little cranky. I missed it. And then the next day it gave me an opportunity. I'm like, okay, cool. And I don't remember which day I got in. But I got into there and I know I put an order out down here somewhere above, what I paid for it. And it closed out part of it. I think I got hit here one day. Because I'll usually go for, depending on how volatile stock is, I'll see if I can pluck 20 or 40 or 50% out of it. Just part of it, maybe a quarter, a third, depending on what it's looking like. Right? You do your analysis, you say, it's a really strong move. I'm going to hang on to the whole thing. Or it's a really strong move. Let me just take out 20%. Or it's a really weak move. I'm going to take out half or 70%, whatever the number is that makes sense. You do your analysis, and based on that, how much of it do I want to bank? How much do I want to leave at risk? So I think I got triggered there, and then it came back up. And one of these days, I reloaded it again at some point. And then I put another below the market, and it triggered somewhere. I think it was that next day. I think I got reloaded here. I don't remember, but so yeah, I mean, I'm still sitting on this thing right now, and I'm pretty certain I have whatever position I have left, I have enough profit on the other parts that I've done that even if that one went to zero, I don't think I'd be losing. So, and that's the ultimate goal for me is to get to a risk-free place. Just like I said with MSTR, even though I haven't done a debit spread in years, but well, you know what? It's a crazy volatile stock. It's got the potential to do it. It's $1.25. I actually just reloaded that 2 days ago because I had just one contract sitting there. I'm like, this thing's bounced back up, but I think if I can get it again, I did again. I bought it for $1.25. I just reloaded the two that I sold before. I think I got them for $1.25. I sold them for 250. And I just re-entered that trade. And so if MSTR drops off pretty healthy again, and I get filled on, I just have one out there actually for 250. So I'll get all my cash back. So I'll still have two sitting there that I don't have any of my own capital into. I've gotten all my initial capital back. I mean, I still have the money sitting there. I could take it and cash that money, right? But I'm like, all right, I'm gonna leave it there and see what happens if I can maximize profits. But I don't have, I have from my initial starting point, I have zero risk. That's the ultimate goal for me is to get to that place. Because then you can relax and just let things play out. Right. There's GLD. We got to wrap with this. I just noticed we're 6 minutes over. I thought I was just a couple minutes over, but well, and there's another. I mean, this is obviously with gold going crazy like it is, but this is one that we were looking at a while back. I did this in the weekly whispers, and I went, you know what? That's a nice ascending triangle. We've got a massive run on gold. So there was the trading plan. I don't like the gappiness of these things, but it trades based on what the futures do overnight. So that's usually why you see the big gaps from day to day, which I'm not a huge fan of. But if you're trading it longer term, it's not as big a deal. But I don't like waking up to a big gap, either being in my favor or against me, because that's no fun. If it's in my favor, it's fun. Actually, I take that back. If it's in my favor, it's fun. If it's not in my favor, it's no fun. I think that goes without saying, right? But you can see, I mean, here's another one, and you can see it gapped right through the entry point, which is the advantage to nibbling. Like I said, if you're looking at this going, hey, I'm going to put an order just slightly above that 316, that resistance level, and maybe pick it up at 317, 317.50, just one or two contracts or 10 contracts, whatever you're comfortable with, depending on what you're working with, then you'd be in a small position here. The next morning you wake up happy. Like, hey, cool. I'm glad I got in a little bit. I wish I would have done 10 instead of just two. That's what you'll say. But at the same time, you got to remember to balance that out and go, okay, I'm glad I have two at least. Because we went from 317, it was 325 the next day. Depending on which one you buy, you're going to have pretty healthy profits right out of the gates. So those are the fun ones. But sometimes if you wait, especially, and you got to take into account the fact that this thing gaps like this, but that's exactly why I like to nibble on things. If I'm not confident, or maybe it's not at my entry point yet, just like with Disney, showed the same thing, but the opposite, right? This is the same thing. And now, if you scale out, I mean, depending on how big a position, I mean, 4 days, usually when you get to the 2-to-1, I'm looking at taking some off the table. Depending on how strong it is and looking at the volume down here, be like, you know what, that's a really strong move. I'd maybe only take, I might not take anything off the table. I might only take, 10% off the table, 20%, depending on, what I'm thinking, what I'm feeling, where I'm at. And then let the rest of it run. And you'd be a happy camper. That's a 5 or 6-to-1 move right there. And you got 25 and it's at 12 points. That's 37 points on 31. That's about 12, 13, 14%. So you're looking at probably a 2 to 400% rate of return on your option. Of course, I'd probably only make 100 to 200 because I wouldn't be peeling it out. I'd be taking some profits as it goes, which I'll take 100, 200% rate of return all day long, especially if within 4 days I've got, half my money or three-quarters of my money back in my account and my risk is almost nothing or is nothing. That's the ultimate place to get to, is if you can say you get in 10 contracts or whatever it is, and you can sell 5 of them for all your initial capital back and then leave the other 5 there and let it run if it does. And then if it runs, you get a massive hit instead of just a little one. I don't know why the market just sold off. The NASDAQ just took a big old dive, at least for 5 minutes it did. So the SPX. There must be news on something. Slowdown in U.S. job market. That's what CNBC is saying, which no shock at all there. So, all right. We got to shut up. It's 10 after now. So, and I want to see what's going on here. So, all right. Any other real quick questions? Oh, I forgot Trip added this stuff here. Oh, Trip put this in. The regulators are moving to dismantle one of the most controversial barriers to active retail traders, the $25,000 minimum equity rule, which is one thing I didn't even realize it, but I started playing with futures. And then I realized, oh, I don't. So I have one small account that I'm working on building up. And I was like, I can trade futures in that. And hence the reason I get cranky on a $500 swing. It's like, that's not a very big account. But sometimes you got to do that. It's fun to go build a small account. Yeah, so they're looking at changing that. We'll see what happens, but regulators are moving to dismantle one of the most controversial barriers for active retail traders, the $25,000 minimum equity rule. I'd say Google it. There's a thing. Trip put the link in here, but I don't know how to share it easily. Just go Google it or go to Grok and ask about the day trading rule being changed. I'm sure you'll find information. I'm assuming that's what Trip probably did. So, I went fast. That's crazy. I don't talk fast. I have to work hard to not do that. So, all right, y'all have a great weekend, and we will see you, I'm sure, very shortly. Take care. God bless. Bye bye.